Okay, in this tutorial, I'll be showing you a stock which is into and it's technology stock. First of all, I'll show you one thing that it's into. Many stocks, that's the symbol. So many stocks have that symbol. For example, it's a technology firm that we will be looking at. But I'll just show you one thing. If I just copy that, and you have to be careful when you're doing that. So attention to detail. So if you write stock, now, if you have a look, it's Into Properties PLC common stock that also has an Into symbol, INTU. So and that's a real estate investment trust company, but we are looking at sector of technology. So are looking at technology. So in case that you just confuse stuff, the best thing is that you just write the sector information as well. So you can just write technology here, and so that's what we are looking at. So it's Intuit, which is also into, so you need to be careful about that. So yeah, so let's start. So I've done that, and let's start with the stock, and it's currently it's 258.31 USD. Okay, 258.31. Okay, and then that's if you want to buy the stock right now. So for one stock you have to pay 258.31 USD, and the year it was founded. This The information on the right is from Wikipedia, and the information which is here and information on the left is from Google. So let's see when it was founded. It was founded in 1983. Okay, and I have the wrong information. And the sector is technology. Okay, and I'll show you from where you can get the sector. Now, there are some ratios that are very important when you're looking at the stock. So this is just when you're looking briefly at the stock, not in detail. I'll go through with you later on. So you just type in Google macro trends, and macro trends is a website that is very useful, which I use often. You go to price ratios and price book ratio and just paste the symbol. So again, you have to be careful. It should be Intuit. That what we are looking at, and I'm looking at the price book ratio right now, and if I have a look, it's 16.44. So which means that the stock is quite expensive right now, because like it's more expensive. It's more, the price is more than the book value, so it means that you're paying 16 times more uh, um, if you buy the stock right now. So it's that expensive, but its worth is not that much. So if I have a look here, it's 18 times more you're paying in 2018, 31st of July. Here, 36 times more you're paying for the same stock. So people who have bought it in 2018 have paid more. So they have bought more expensive, 36 times more they have paid. So the stock was more expensive in 2018, 31st of January, than it's now, which is 16 times expensive. So it's the same stock, but it's just the expense is more. So people who will buy now will be better off than buying who bought in January, because they can buy more stocks for low price. But still, the stock is 16 times more, which is not very good. If I look in 2015 July, it's 12 times more. Then in 13 July, 2013 July, it's 5 times more. And then in 2009 March, 30th March, it's 2.65 times more. So people who bought that time, they are better. They could buy more stock than the people who are buying right now, because it's a lot expensive. And when it so the lower the if it's zero, for example, it means it's the same as the book value. The stock price is the same as book value, which is very good. So it was very expensive in 2016, then 2017 January, then 2008 January. So the trend in January, it's very expensive. So now it just got down, and it's 16 times more expensive, which is still a lot expensive. Um, Now, if I look at another one, it's debt to equity ratio. I can just click on other ratios, and I click on debt equity ratio, and then I will look at this one. It's 0.1. Debt to equity ratio must be zero point 0.5 or below that to be risk. It's not risky if it's zero point 0.5 or below that, because it means that the company is not operating on long-term debt. Like it's operating more on equity and less on long-term debt. So, which it makes it less risky. So this situation is very good. It's zero point 0.1, which means that the long-term debt is way below equity. So if I just go back and it's uh, consistently now in 2017 January it's 0.59, which is above zero point 0.5, which is not very good. It should be zero point 0.5 or below that. So but in 2016 January it's 1.56. They have taken more, a lot of debt, but they have very less equity compared to that. So this makes it very risky to invest in, because it's it's operating mainly on long-term debt than shareholders' equity. So it's very risky here. Here it's fine, 0.48, and if you go back, it's everything is fine because it's consistently, but except these figures, but consistently below zero point 0.5, and only once in their period in 2016 it's above, a lot above zero point 0.5. Otherwise it's consistently below zero point 0.5, and now it's zero point 0.1. So maybe once off is not that bad, but the consistency has been very good, and so that's fine. And then if I look at okay, and if I look at the current ratio, no, if I look at the um, return on equity, I click there, it should be 8% or above that for it to be very good. So let's have a look. The return of equity is 46.37%, which is a lot above 8%. So it's very good. It means it's getting a lot of return. Shareholders have invested, and it's giving them a lot of return. Um, and if I just go back, it's a lot above the 8%. It's consistently above 8%, which is what makes me happy about the stock. And so it should be 8% or above, so that's really good for that. And the current ratio should be 1.5 or above that for it to be risk free. It could be 1.2, that's also good, but you want to have as much safety as you can, margin of safety. So it's 1.86, which is very above 1.5. That's really good. Then that's 1.32. It's still good, but it's 1.5 is a very good margin of safety, but it's still good because it still says that the assets are more than the liabilities. So let's have a look. But here it's dangerous, because if you look here, the assets are, if it's below 1, that means that it's very risky, because the liabilities are a lot more than the assets in 2018 January. And then anything that's below 1 is very risky. So this stock might be risky because it's a lot, the liabilities has been more than asset consistently for this like 3 years maybe, and then from 2015 to 17. And then if we go back, it's more than 1.5 or more than 1 even. So there has been ups and downs, but you know right now it's from 2018 it has gone up, so it has recovered back, but it's not very consistent from 2015, which is very recent. So we need to take care about that, because it's even below 1, which is not very good. It's a lot risky to invest here. And if I look at the dividend, so if we go back to Google, I can see the dividend yield 0.73%. Now, firms that pay off dividends shows their stability, that they are doing very good and this and that, because they have dividends are extra money that firm has that they can just pay off their shareholders. And so this is something extra they are paying off in cash, so it means the company is doing very good. Any firm that, even though the dividend percentage is very small, 0.73%, but still it gives a very good picture of the firm, that it is generating very good money, that it can give free money to people, to investors. The market cap is important because you need to know if the firm is big or small. So if it's in millions, it might be a medium size. This is in billions, 66.97 billion. So it's a big firm. And if I want to see, I can check. I'll just copy this, and I will just paste this, and I'll type Indeed reviews, which will give me a review what employees think about this company that work, because that will be quite honest review, hopefully. So I'll just compare the symbol Intuit, and that's the same one, yeah, because in case any firm has the same name, or so you can just check that. So it's 4.2, and there are 1.2k reviews. 4.2, which is very good. You can read through all the reviews you want, just to know how the people who work here feel about it. And same, you can do in Glassdoor as well. So you can just click on that, and you can see reviews. So it's 4.4k reviews, and it's 4 star, which is really good for a firm, getting a 4 star, because every firm has some problems. So that's really good. If I just type in patents, and just go to Justia Patents website, and you can just search it on top, and I'll just search that, and make sure, because you need to have the right name exactly, because sometimes you could be mistaken. And you need to type in the exact name in the search bar, so that you have the exact thing. And you need just ignore the inventor, because that's it could be anybody, but the applicant means that they have the full right of the patent. So you need to concentrate on the applicant. So Intuit Inc. is the applicant, which is 2012. Okay, and then patents are like act as a moat, so that it gives you safety, because the more people innovate, so it means this firm is innovating to be different from its competitors, and to survive and thrive for long term. So innovation is very important. So if it's innovating, it will have patents, which is a good sign. It's a plus point. In 2012, it has patent, and then 2012 again. So it has a lot of patents in 2012. And the thing that worries me is that you need to, in 2013, it has, you need to be sure that it has been innovating all years, like 2007. So there are two patent holders, so we are just interested in this one, so that's fine. But the point is that assignee is same as the applicant, so that's the same as assignee, so it means that they have all the rights. We are not looking at the innovators. But the thing is that you need to be careful that these people, the firm is also innovating. They have recent patents, like in 2018, 17, 16, because sometimes they're innovating when they started, and then they stop innovating, and so their their competitive edge is no more relevant. So you need to be careful in 2007 than in 2007, but that's like 10 years ago. So that's in 2017, which is very good, because that's a recent one. 2017 November, again they have 2017, which is really good. And then I'll be interested in 2017, 17, very good. And then you can just go through it, because it's a long list, and it will just make the video long. So you need to be careful that do they have recent patents as well, or is it is just an old one, because that means that they are still doing their best. In 2018 they have 2018, which is very good. Now let's have a look at Yahoo Finance. I'll just show you briefly about Yahoo Finance. There's a lot to learn from there, but I'll just show a little bit. Yahoo Finance in Google, I've typed that. I'll click on the first one. I'll click on here, and I'll just paste the one I'm looking for, and I'll search. Why isn't coming? Actually, I'll just type that in Tweet. Or yeah, that's the fine. I don't know why it wasn't working. Okay, I'll just click that. It's Intuit Inc. Okay, and go to profile, so you can also have a look. And then now the sector I was talking about, I was talking here about the sector is technology. You can just have a look. This is the sector technology. This is the industry software application, full-time employees and everything. There's a lot of information to look at. and the key executives I'm just interested in. So the key executives, it's very important if the company shows the if the company shows the salary of the employees. It's very important because it's more transparent and more reliable, hopefully. So you can just read through all the key executives and all the salaries are present, and you can also search each of them in LinkedIn or look at their previous work as well, and when they joined and stuff like that. But so they have shown all the salary of the people. And not only that, you can compare this with their rivals, what salary they are getting, because that's very important as well. So you can just have a look as well.